Behavioral Finance, Lecture 20. Lecture Outline. Hello, welcome to Lecture 20 of Equity Master Secrets. This lecture is called Behavioral Finance. The first thing we're going to talk about is, are stock markets efficient? And this is probably something you've heard or seen before, and we'll talk a little bit in detail about what we mean by this. Next, we're going to discuss what is behavioral finance. Then we'll talk about the natural science versus the social science. And these are all concepts that are linked with behavioral finance. We'll talk about fallibility and reflexivity. Then we'll talk about behavioral finance and value investing. Then we'll talk about the 4 quadrants of awareness. And finally, we'll conclude. So this lecture is essentially going to be talking about behavioral finance and all of these various concepts that fall within behavioral finance and how they affect value investing and our investment decisions. Okay, let's get started. Are stock markets efficient? So the first thing we're going to talk about is market efficiency. And we want to ask the question, well, are stock markets efficient? So typically whenever we buy a stock, whenever we're buying a stock, we're essentially thinking that the price we're paying for it is less than what it's worth, right? Or equivalently, it is worth more than the price that we are paying for it. And whenever we sell a stock, we're assuming that the value of the stock is less than the price that we are selling it at, right? So we may think that in this case the price is above the value, so therefore it's worth selling. But as per one investment theory, this is just a myth. The efficient market hypothesis put forth by Nobel laureate Eugene Fama in 1970 states that it is impossible to beat the market. And the reason for this is that it assumes that stock prices fully incorporate and reflect all relevant information at any given point in time. So this is essentially what we mean by market efficiency. Okay, market efficiency is essentially the idea that the current stock price reflects all relevant information at any given point in time. So, and equivalently, this would translate into the fact that, well, whatever the stock's price is, that is what it's worth, because that is the value that it reflects, right? It reflects all the information in the stock. So there's no way that you could learn something new about it that's not already incorporated into the stock price. So this means that stock prices are always trading at a fair value, and hence stock selection and market timing have no value in the long run. And there's something like the efficient market hypothesis is still debated today, despite the fact that it's been around for some time. And there are still many people on both sides of the fence that think that markets are quite efficient, and some that think that are not. Right? So if you thought that markets were efficient, that you couldn't beat the market by selecting stocks, your best bet might just be to invest in an index fund, right, and earn whatever the market return is. Whereas if you thought that markets were not efficient, then you would say, well, maybe it's better if I go out, look for stocks, find stocks that are the best, and try and outperform the market by buying those stocks. So depending on your view on the efficient market hypothesis, that should in some ways help you to help guide your investment decisions. Are stock markets efficient? So let's suppose that markets were truly efficient. If that were the case, then we would have a lot of phenomena that are quite difficult to explain. So, for example, if markets were truly efficient, how would it be possible for value investors such as Warren Buffett to consistently and substantially outperform the markets for decades? Okay, and this is an important point because clearly we've seen examples where it is possible to outperform the market in the long run. And in our view, the efficient market hypothesis has several flawed assumptions. The first is that it assumes that investors are perfectly rational in their behavior and that they are all acting on the same public information. And in making these assumptions, the efficient market hypothesis ignores the crucial element of human behavior, and its impact on the markets as well as the economic landscape at large. And all of this brings us to behavioral finance. And behavioral finance is essentially a field of study that argues that human behavior is not as rational as presumed by the traditional finance theories. So let's take a step back and think, well, if stock markets are not efficient, okay, because we do see that, it is possible for investors like Warren Buffett to beat the market over time. Our view certainly is that it is not efficient, and the business that we are in, right, which is, analyzing stocks and trying to find undervalued companies, the whole premise for that is that the market is inefficient, right? The whole reason we do this is because our view is that we can find stocks that will perform extremely well, right, and that can beat the market in the long run. And it's a very fair point that the markets are not easy to beat. That's definitely true in practice. The markets can be beat with a lot of analysis and a lot of work, but it's not easy. So the efficient market hypothesis, in some sense, is not completely wrong, in that the market is still difficult to beat, but it does suffer from some flawed assumptions. And one of these assumptions, which is the impact of human behavior, which is not completely rational, this leads us to the study of behavioral finance, and that's what we're going to spend the rest of this lecture talking about. And the fact is that humans make mistakes, right? They, we have bubbles, we have, depressed prices for long periods of time, and a lot of it's to do with just human nature and how humans interact with the markets. So behavioral finance, we're going to talk about some of the mistakes that investors make, and also this is useful, one, in understanding how it affects markets, and also in trying to find these behaviors in yourself and then correcting them. All right, let's now go talk about behavioral finance. What is behavioral finance? So let's start by talking about the definition of behavioral finance. So behavioral finance is an interdisciplinary field of study that integrates finance, economics, psychology, and sociology to offer a holistic understanding of human behavior in financial markets. So the key thing about behavioral finance is that we're trying to understand, how do humans behave, right? How do investors behave in the stock market? And how does this behavior that's not necessarily rational, okay, how does that actually affect the markets and affect market prices? So traditional economics and finance theories tend to assume perfectly rational behavior, and they tend to eliminate irrationality and bias as noise, okay, that is essentially unimportant, and most agents or all agents are rational. So this is the traditional economics and finance theories, and the behavioral finance theories, which is kind of challenges these assumptions, right, of rationality, essentially puts forth that human emotions and biases play a critical role in economic activity and stock price movements. And we're going to now try and understand why it is critical to have a basic grasp of behavioral finance in the context of stock investing. So one important point to make here is that a lot of the traditional economics and finance theories, they assume that investors have rational behavior. Obviously, that's not true, right? Because people do make mistakes, and we make mistakes ourselves. I certainly have. So that can't necessarily be true, but what often these traditional theories assume is that even if some investors are not rational, okay, it shouldn't matter for stock prices, right? So that's kind of the way to think about these traditional theories, that even if some people are not rational, the market's going to not be affected by that as long as enough people are rational, right? Whereas behavioral finance is going to take the view that a large number of people are irrational, and this irrationality actually has a big impact on the market, right? So it actually can impact stock prices quite significantly. So that's, in some sense, one of the key distinguishers between these traditional theories and behavioral theories, is that a traditional theory will assume that, even if there was some irrationality, it wouldn't affect the market, right? It wouldn't be anything useful. Whereas behavioral finance is going to say that, it actually plays a central role in the market. So we're going to go on and talk more about how this works and, how exactly behavioral finance can affect the stock market, okay? And why it's really important to understand it. natural science versus social science. So in order to motivate our discussion, let's first understand the basic differences between natural sciences and social sciences. Natural science looks for explanations of the various phenomena in the world around us. And it studies events that consist of a sequence of facts. And the chain of events leads directly from fact to fact. However, in social science, events have thinking participants. So let's go back and just see what do we mean by studying events that consist of a sequence of facts. Essentially, when we're doing natural sciences, we're studying something like, say, law of motion, right? If I throw a ball in the air, with a certain amount of force, how far does it travel, what speed does it travel at, and so on and so forth, right? So that's kind of what we mean by natural sciences, by trying to explain these types of phenomenon. And in social science, one of the key distinguishers is that we have thinking participants. And what this means is that in a natural science, what a person or a group thinks does not have an impact on the final outcome. Okay, so if I throw a ball in the air, no matter what anyone else thinks, okay, or what I think, that ball is still going to behave in the same way, right? It's not going to be affected. Whereas in the social science, it's more complicated because we're studying people, right? We're studying human behavior typically. And humans can think, humans can change their minds, humans can do different things than what we might expect. So the fact that they're thinking about something can actually influence the outcome that we're interested in, right? So this makes social sciences more tricky. And what this also means is that it is more difficult in social science to come to a definite conclusion the way we do in natural science, right? So when I'm throwing a ball in the air, I can conclude quite precisely what happens when a ball gets thrown in the air. Whereas with social science, it's more tricky because you're never sure, causal impact, because people can change the behavior based on what they're thinking, and people's behavior can be inconsistent. They can behave one way at a particular time, and they can behave another way the next time. And the conclusion in social science will always be colored by what the participants think about it, right? So the way participants think has an impact on the outcome, and unfortunately we don't always know what everyone's thinking all the time, right? So you can't actually look into someone's mind and see exactly what they're thinking, so we have to make some judgment calls, and it means that it's more difficult to come to definite conclusions in social sciences. And thus there can be no generalizations, predictions, and explanations in social science like the kind we see in natural science. Okay, so social science is more of imperfect, and we're not going to be able to come to the same precise conclusions that we do in natural science. Behavioral finance stock markets. So let's now take this understanding of social science, right, where we have thinking participants, okay, and we're going to understand two behavioral concepts. And these are espoused by legendary hedge fund manager George Soros. So like Warren Buffett, George Soros is also one of the world's most successful investors, though he is not a value investor. He typically does macro investing, which means trading currencies, interest rates, market indices, and so forth. So there are two important behavioral concepts that we're going to discuss. The first is fallibility, and the second is reflexivity. And the basic idea is that the world is so complex that no individual can understand it fully. Okay, that our brains have a limited amount that we can process, and we know that this is true because if you try and give someone too much information at the same time, then they typically are not able to process it correctly. So the way this translates into behavioral finance is that in situations where we have thinking participants, okay, so like the stock market, where we have investors that are making decisions based on what they think, the participants' view of the world is always partial and distorted, right? So investors never have the full picture. That's because it is complex. Because of the complexity involved, we don't always have the full picture, and as a result, our view can become partial and distorted. And this is known as the principle of fallibility. Okay? It means that human perception is inherently flawed and biased. So, in the context of investing, it means that when investors take decisions, right, when we buy or sell our stock, our perception of what's going on is not always going to be accurate, right? There's no objective way to say that, now we know everything about the stock that we're buying, right? So, human perception is flawed and it is biased, and this is because the world is complex, right? It's not necessarily the individual's fault. All it means is that because the amount of information is just so large that it's not really possible for us to process all of it, that we have to only process some subset of it, right? So some portion of it, and people might choose to focus on different portions. So individuals may have different pieces of information when they come to an investment decision. So as a result, we get these distortions and we get these biases in human perception. Behavioral finance stock markets. So in theory, stock prices attempt to continuously incorporate and reflect all available news, information, and future expectation. So one thing you will find is that, stocks do move very quickly, all right? And especially in response to news, you'll see stock prices move extremely quickly, right? So if, for example, we got a GDP report that said, GDP growth was higher than expected, you might see the market jump up right away as that announcement is made, right? Very, very quickly. So stock prices do move quickly, and they do, respond to news. However, but both ongoing as well as future economic events are highly dynamic, variable, and impacted by a large set of factors. So even though we might see the market move whenever there's an announcement, right? And at the individual stock level, let's say you had an earnings announcement that was, a lot better or worse than expected, then you typically might see that stock move a lot as well. So even though the stock moves, it doesn't necessarily mean that it's moving, the right amount, right? So, and the fact is that, a lot of these future events, are highly dynamic, variable, and impacted by a large set of factors, meaning that it's quite difficult to predict actually what is going to happen in the future. So even though the markets may adjust to new information, there's no way to be sure that it's doing so correctly, right? There's a lot of factors involved. And it is really, humanly impossible to fully comprehend and appropriately price in all the information and news. And this is why, markets can be inefficient, right? Because even though we have news and even though the market may respond to it, it's hard to believe that the market can actually process all that news very, very quickly, right? So you might see the market move as soon as an earnings announcement is made, but actually, in order to fully comprehend the information, one would actually have to go through the earnings statement in more detail and figure out what's going on, right? And that's not going to be priced in right away. So effectively, what this means in practice is that market participants base their buying and selling decisions not on objective conditions, but on their limited and imperfect interpretation of those conditions, right? So when the market moves in response to an earnings announcement, that's a limited interpretation of those conditions, right, of that announcement. Because it's not possible to, analyze that announcement in half a second, right, and analyze, the entire details of it. So even though the market's going to move in that very short space of time, that may not be reflecting the full information in that earnings report, right? So market participants will base their buying and selling decisions on whatever limited information that they have. Behavioral finance stock markets. So the concept of reflexivity applies only in situations that have thinking participants. And there are two key functions that the participant's thinking serves. The first is the cognitive function, which is to understand the situation around us, right? So the cognitive function is what we use to understand what's going on. The second is the participating function, which involves action aimed at changing the situation to one's benefit, right? So in the first case, we're analyzing and understanding what's going on. In the second case, we're doing something about it, right? We're taking action in order to perhaps change the situation. So in the cognitive function, the outside reality, so for example, the news, information, stock price movements, these are the things that are supposed to determine the investor's view. And in short, the direction of causation is from the outside world to the human mind, right? So what we see outside, that impacts us, that impacts our cognitive function, right? It changes how we understand what's going on, right? We take the available information outside, process that in order to understand what's going on, and that's how the direction of causation is from the outside world to the human mind. And in the participating function, it's the other way around, right? In the participative function, the direction of causation reverses as the actions and decisions of the investors have an impact on the outside reality, the stock markets in this case, right? So in the first case, we're saying that, well, what's happening in the market, okay, what's happening in the market and perhaps the news about the market and so on, that's affecting the way we understand the market and the way we understand what's going on. And based on what we understand, we're then going to participate to try and change something, right? So we're going to do something about it based on what we understand. And when we participate, the causation gets reversed, right? So our actions, let's say as investors, whether we buy or sell or do neither of those, that has an impact on the stock markets themselves, right? So our decision to buy or sell impacts what happens to the stock market. And obviously, an individual's actions on their own may not have an impact on the market, but collectively, when you put together all investors' decisions, then that moves the market, okay? So that's kind of, key to understanding this concept of reflexivity is that we have this, causation going in both directions. Behavioral finance, stock markets. Since both the cognitive and participating functions operate simultaneously, they tend to interfere with each other, right? So we keep seeing what's going on in the market that affects our actions, and we participate in the market, and it's a constant process that interferes with one another. And the actual course of events, of course, influences the participants' views. And at the same time, the participants' views also shape the actual course of events. Right, so this is this two-way causality we're looking, right? Like what's going on in the market influences our views and what we're going to do, and then what we do then in turn affects what's going on in the market. So, as we've been talking about, the best way to understand this is in the context of stock markets. So the markets tend to shape the investors' views, but the markets are not an independent variable. They are simultaneously being shaped by the investors' views. And this results in a two-way reflexive feedback loop between the participants' views and the actual course of events. And since the participants' perception is inherently biased, and there exists a reflexive relationship between the participants and the market, it follows that market prices present a biased view of the future. And this effectively debunks the premise that stock markets are efficient. So, the concept of reflexivity, as we've seen, is understanding that, as investors, we take in what's going on in the market, right? Our decisions are impacted by what we observe in the market, and then simultaneously, the market is impacted by the decisions that we make. And the reason we have the biased view of the future is that our perceptions are flawed to begin with, right? Because we, do not process all information. We cannot possibly process all information. Our information set is limited. This is going to mean that our biased views are then feeding back into the market, in turn determining market prices, and as a result, the market prices may present a biased view of the future. And this is kind of the main, logic behind why the stock markets are not efficient. Okay, so that's kind of what we're aiming for here, right? Is to try and come up with a good explanation, right? A quite robust theoretical explanation for why the stock markets need not be efficient, right? Because the efficient kind of market hypothesis has a very nice theory around it, right? Saying that if investors are rational, they'll buy up undervalued securities, sell overvalued ones, and so securities will always be trading at their fair value, right? And then through these behavioral finance concepts, we can show that, well, maybe this is not actually the case, right? Because we have all these biases, and we have fallibility and reflexivity, it means that stock markets are not efficient. Behavioral finance and value investing. So far in this lecture, we've covered some characteristic features of social sciences and stock markets in particular. And we discussed the presence of thinking participants and how that makes the social science different from the natural science. And the presence of these thinking participants in the market makes stock price movements less than a perfectly rational process. The allegory of Mr. Market was coined by Benjamin Graham on exactly this premise. So Mr. Market is nothing but a collective embodiment of collective behavior of the market participants. Right? So you can think of the market movements as being the aggregation of all the individual participants' decisions to buy or sell on the stock market. And the manic depressive tendencies of Mr. Market often result in markets swinging between the extremes of optimism and pessimism. Right? So markets go through bull runs and bear runs, and these are quite pronounced when they do that. So you tend to see, large increases in stock price sometimes, and sometimes large decreases. And this is kind of the, quite volatile behavior of the market. And the value investing approach is really designed to take advantage of opportunities that arise because of Mr. Market's often irrational and emotion-driven behavior. So the whole premise of value investing is the idea that stock markets are not efficient, right? And sometimes prices get depressed, and sometimes prices become very high. And when we're buying, value stocks, we're really looking for stocks where prices are depressed, right? So there's maybe a lot of pessimism, and as a result, stock market, certain stocks are cheap and they're good buys. And to be able to take advantage of the inefficiencies in the market, participants need to not only recognize the mood swings of Mr. Market, but also take steps to minimize their own thinking errors and biases in their investment decision-making process. So we've talked about how market participants can be not completely rational, right? And obviously we need that in order to get the inefficiencies so that we can take advantage of it. It's also equally important to keep in mind that we are also market participants, right? Whenever we go and invest in a stock. And we also have to keep in mind these biases and do our best to minimize them and to be as rational as we can when it comes to making investment decisions. Right? So there are degrees of rational behavior as such. Like some investors are better than others in terms of being more objective, and some are not. So it is a spectrum. And obviously we want to be as close to rational behavior as possible on that spectrum. Inside the human mind. So now let us shift our focus from market behavior to the mind of an individual. And we will first try and understand why human thinking is inherently biased and partial. Okay? And the human brain is constantly stormed by millions of sensory impulses. Right? So this means that we receive a lot of signals over the course of our day and over the course of longer periods as well. And these obviously impact, how we process the information around us. So despite the fact that we're stormed by a lot of signals, a lot of impulses, our consciousness can only process a few subjects at a time. The impulses need to be condensed, ordered, and interpreted under very large time constraints, right? So, for example, when when you're driving in a car, there are lots of things going on at the same time, right? But you're not necessarily going to be focusing on everything at once because you need to focus on, driving the car. So, as a result, you may ignore a lot of other things that are happening around you. So what happens as a result of this is that thinking errors and distortions are direct consequences of the brain's limited capacity to process the flood of sensory impulses. And this is quite really normal behavior, right? When you're in any environment, you're typically focusing only on one thing or a couple of things at once, right? You're not going to be focused on every single thing that's happening at the same time because it's just not possible for our brains to do that. So, based on this, it is fairly clear that it is practically impossible to eliminate thinking errors and biases, right? We're going to have to, not analyze everything completely simply because we just don't have the time to do so, right? And we tend to rely on, rules of thumb and heuristics and things like that in order to actually make sense of things that are going on that are not necessarily as important. So even though we do have these biases, it is certainly possible to reduce their impact, right? The more understanding we have, the more self-awareness we have, we can minimize the negative consequences of such biases. So, as we said earlier, when it comes to making, good and bad decisions, it is a spectrum, right? It's not that we're all going to make bad decisions all the time. Some people will make better decisions more often than others, and we want to be in that camp, right? We want to be, ideally in a situation where we understand our own biases and we can really do the best we can in order to minimize their impact. 4 quadrants of awareness. So now we'll talk a little bit about awareness, right? So awareness are things that, that we know or that we don't know. And we can really broadly categorize this into 4 different quadrants. The first is what we know, okay? The second is we know what we do not know, right? So in the first case, this would be something like, well, we know that the stock market went up yesterday or went down yesterday. We know what we do not know, right? So for example, if we're analyzing a company, we do not know every single thing that goes on, behind the financial statements. We only see a limited picture. We do not know what we know. So this would be a situation where we don't know that we're actually aware of something, so perhaps we're ignoring it. And the 4th quadrant is we do not know what we do not know. So these are things that we don't know about, and we're not aware of the fact that we don't know about them. So something that could happen and it wasn't even, it never crossed our minds. And this is a useful mental framework that can help increase self-awareness and thereby minimize thinking errors. And what we're going to do in the remainder of this lecture is briefly discuss each of these 4 quadrants, okay? And how they affect our investment decision. So, as we do this, try and keep a mental list of, the facts and things that, where you would place them into each quadrant, right? What are things that you know that you know? What are things that you know that you don't know? How about things that you don't know that you know, and things that you don't know that you don't know? Okay? So, it may seem a little tricky at this point, but as we go through talking about each of these quadrants, it's a good idea to try and apply some, real life examples to these at the same time. First quadrant. So the first quadrant is that we know what we know. And most of our waking conscious self, we live in this quadrant. And this quadrant includes all the things that we think are consciously known to us, right? So things like what happened to the stock market yesterday, right? This is something we know, and we know that we know it, right? Or things like, this is where I work, this is how I get to work, this is what I'm going to eat, and so on and so forth, right? There were things that we're consciously aware of, and we know that we're aware of them, and we know what they are. So sometimes what happens is that our ego tends to artificially inflate this quadrant by including things that we don't really know. So sometimes we may claim to know something, whereas actually we don't know it very well. So for example, if you simply possess an academic degree in a certain field, that doesn't necessarily make you an expert, right? Typically an expert in a field is someone, who's also had, say, a good experience as well, right? And typically just learning about things will give you some knowledge, but it may not give you all the knowledge that you need in order to call yourself an expert. And sometimes people often confuse academic qualifications with actual internalized knowledge, right? So you might assume that just because someone has a degree in a certain subject, that they know about it very well. But in practice, this may not be the case, right? Because these are just labels, and you don't always know what's behind that. And even if we're only thinking about the book knowledge, someone could have got a degree and just barely passed and not know it very well. Or someone could have, done extremely well and know the material that they learned very well. And you wouldn't necessarily be able to tell just by the fact that they have a degree. And also the experience component is important, right? If you don't have experience, then there's a certain knowledge that you still have to build up over time, right? There's some things that it's difficult to learn just by studying them, and you actually have to go out and get the experience in order to become an expert in that particular field, right? So the most important thing to remember about this quadrant is that we do sometimes include things that we don't really know, and it's good to be aware of this as much as possible. First quadrant. We know what we know. So now let's talk about how does this first quadrant impact stock investing, right? Where does this come into play? And what are some of the mistakes that occur based on what goes on in this quadrant? And it turns out that the maximum investment mistakes happen in this quadrant. So why is that the case? And typically what happens is that people don't fail because of what they don't know, but they often fail because of their failure to understand their circle of competence. So what this means is that, we tend to, as we mentioned in the last slide, include things that we don't know, but we think we know them, right? And that's essentially what we mean by understanding our circle of competence, right? So our circle of competence is kind of saying, well, what are the things that we're quite competent at, right? What are we good at? What do we know well? And we need to understand this in order to be making good investment decisions. So, for example, one of the biggest reasons for Warren Buffett's immense investing success has been his ability to clearly understand his circle of competence and to stay strictly within it. A good example of that is, Warren Buffett doesn't really invest in technology companies, right? And some of the reason he gave before is that he doesn't understand them, right? Doesn't understand how they work, and as a result, is not comfortable investing in them. And that doesn't mean that technology is not a good investment, because there are plenty of technology companies that have done very well. But in this case, Warren Buffett's circle of competence didn't include these, so it was best to stay out of these stocks that he didn't know very well. Okay, and that's the basic idea we want to keep in mind. We need to know what we're good at, right? What are we an expert at? And stick to that, because that's really where our advantage lies, right? If we stick to where our advantage lies, then that will increase our chances of investment success. And it also means that if we want to branch out into different areas, we need to make sure we have the requisite knowledge and learn about them and become experts in them before we go ahead and do that. Okay? So understanding the circle of competence is very, very important. And obviously increasing the circle of competence is also important over the long run, as this can widen your knowledge base and improve your results. Second quadrant. So now let's talk about the second quadrant, and this is we know what we do not know. And this quadrant relates to the state of awareness that pertains to learning and inquiry. Right? So we mentioned this briefly earlier, that we need to understand our circle of competence. And in the second quadrant, we're going to think about, well, what are things we don't know, and perhaps we can learn about them and improve that circle of competence. And all good investors reside largely in this quadrant, as they understand the limitations of their knowledge. Alright, so as an investor, if you're aware of what you don't know, then you know what to avoid. Okay, and good investors share this characteristic, right? They're aware of the things that they don't know, and they stick to what they're good at. So just like it is important to know one circle of competence, right? So what you're good at, it's also important to know what lies outside that circle, right? So what you're not so good at. And that's as important, because then you know what to avoid, right? You know what things to avoid because you know that you don't know them. So this is an example of Warren Buffett and technology. So here's the specific example. So Warren Buffett never invested in Microsoft, despite having been a longtime friend of Bill Gates, the billionaire founder of Microsoft. So he quotes and starts as follows: "The fact that I could have made billions of dollars from Microsoft doesn't mean anything, because I could never understand Microsoft. We're willing to trade away a big payoff for a certain payoff." So what this means is that Microsoft, as we know, is a company that's extremely strong, has done very, very well over its lifetime, And Warren Buffett never invested in this company, and the reason is that he didn't understand how this company worked, right? As we said, he typically does not invest in technology companies. So this doesn't mean Microsoft was not a good investment. Clearly, it has worked out very well if you bought it early. But if this was not in your circle of competence, right, if technology companies were not in your circle of competence, then it's probably best to avoid them, right? And that's what a successful investor like Warren Buffett has done. And even though it means giving away a big payoff, it's the fact that he's acting within his circle of competence makes him more successful overall. Third quadrant. We do not know what we know. So now let's carry on our discussion about the third quadrant. And the third quadrant relates to our subconscious self. It also includes genetic and sociocultural learning. And people belonging to a certain social unit usually tend to bear certain common behavioral characteristics, right? So if you're part of a group, right, or part of a social unit, you will share, certain characteristics among people with that unit. So, for example, characteristics that we generally describe as exuding Indianness, right? So if you take a group of Indians and compare them to a group of some other country, people from some other country, you'll probably find common characteristics among the Indians, and we would call this Indianness, and you'd probably find some other common characteristics with the other group as well. And these are essentially what we're talking about when we look at certain common behavioral characteristics. And these characteristics are passed on from generation to generation and become integral to one's psyche and often determine our instinctive responses to various situations. So often the context of our own culture and our own social status or economic status will often determine our instinctive responses to various situations, right? So typically you'll often find that Indians tend to save a lot, right, relative to people in the U.S. And that's something that's quite common to Indian culture, and this is the result of a difference in societies and a difference in the attitude towards spending and the attitude towards saving, right? So that's just one example of how you see differences in behavior across countries and how this might be determined by these common behavioral characteristics among groups, right? So when we're looking at financial markets and we're thinking about instinctive responses, we should also keep this in context that those instinctive responses may be partially shaped by what's going on with with the socio-cultural background and genetic background. Third quadrant. We do not know what we know. So in the investing context, this quadrant is responsible for the instinctive responses that we apply to economic situations without knowing why we do what we do. So typically whenever we have impulse responses, right, so we respond to something on impulse, we don't necessarily know why we do that, but we do it anyway, so it is the case that we do not know what we know. So from an evolutionary perspective, the brain does not have the mechanism to deal with stock markets. Stock markets have only come into existence very recently, just a few hundred years ago. So from the evolutionary context, looking at human history, stock markets have not been around for most of that time. And it is too trivial a period for the brain to evolve a mechanism to deal with it. All right, so we don't necessarily have an instinctive mechanism to deal with stock markets very well. So instead, the brain uses the reward center in the brain, the amygdala, that was developed to deal with food, satiation, and sex drive to deal with money and markets. And it goes without saying that it is this response mechanism that is responsible for all the chaos in the financial markets. And this is the reason why investors get lured to buy when markets are rising and when everyone else is buying. And this is also why investors confuse volatility as a risk in stock investing rather than focus on the risk of fundamentals going bad. So we've all heard the idea that, the markets are driven by fear and greed, right? And these are kind of our natural impulses that we end up using in order to deal with stock markets, right? And that's why, we'll see people get very excited when stock markets go up. They'll just buy more. And They'll do it because everyone else is buying, so there's, herd mentality and so on. And this is not necessarily a smart way to invest, right? Often this means that people tend to invest when markets are overvalued rather than when they're undervalued. It also means that we instinctively stay away from volatility, and volatility itself is not a bad thing because volatility has upside as well, right? So really we want stocks that have upside volatility that are likely to go up, and we want to focus on the risks of fundamentals going bad, right? So really we want to focus on, the risks of the downside risks to owning an investment rather than volatility as a whole. Third quadrant. We do not know what we know. So let's talk about another important concept in the third quadrant. So there is another human instinct that causes investors to make big mistakes. As a self-preservation instinct, each individual believes in his own uniqueness. So uniqueness means that, you're different from everybody else. And it leads us to believe in the uniqueness of our thoughts and ideas. So we may come up with an investing idea and think that no one else has it, when actually that may not be the case at all. And it often prevents us from assessing whether others too hold the same belief. And this instinct proved to be dangerous when a person is susceptible to herd mentality. So often, if a lot of people hold the same idea as you, that can create a herd mentality phenomenon and can cause, for example, prices to go into a bubble and subsequently large losses. And the same may happen if an investor may think that his thoughts are independent and unique, but they're actually not, right? So typically the market will often price in, expectations about the future, right? And if everyone has the same idea and you have the same idea as everyone else, that may already be priced into the market. You may not actually be able to earn a return from making investment based on that idea. So it's important to keep in mind that, we may think that we're the only ones or we're one of the few to have these ideas, but actually they're a lot more prevalent than we might first imagine. And we may fail to recognize that other investors too are thinking along the same lines. And the reason this often happens is because as investors we tend to have access to a lot of the same information, right? We have the same, companies' financial statements that we look at, and even in terms of news and in terms of understanding what's going on in the world and in the financial markets, we often use the same similar sources of news, right? There are only a few major news sources for these things, and as a result, our views may be, correlated and quite similar to one another. And the history of bubbles and crashes shows the danger of ignoring this quadrant of one's awareness, right? So often, like, as we said, herd mentality, when everyone thinks the same way, can often lead to bubbles, and this is usually followed by crashes as well. Fourth quadrant. We do not know what we do not know. So this quadrant of awareness relates to the realm that is beyond all knowns. So these are things that we don't know, and we don't really know that we're not aware of them either. And this stems from the fact that our knowledge of the world is distorted, limited, and incomplete. And we've talked about the reasons for this is that just because the brain, can only process a certain amount of information at a time. And as such, all our thoughts, ideas, and belief exist as mere possibilities as we do not know enough to be absolutely certain. Alright, so that's, for example, when we, think a stock is going to go up because we've analyzed the company, there are always going to be factors that we haven't anticipated that could impact the stock, right? And we're not necessarily aware of this, right? So something like, for example, a natural disaster could take place, and there would be no way for you to, take that into account when you were valuing a company. That may significantly damage, a company's assets, for example, leads to a large fall in the stock price. So these are certain things that we just really cannot anticipate, and we don't know when they're going to happen. So this quadrant is not only the largest, but also the least understood. And typically, because we don't know, what to expect or what to anticipate, it's a bit hard to deal with information in this particular quadrant. So we're going to talk a little bit about this quadrant in the context of investing. And, before we do that, just to give you some intuition about how this quadrant works. You can think of things that are extremely unexpected, right? That things of events that have happened that are very unexpected, where there was no way for you to anticipate beforehand that this was going to take place, right? So something like a natural disaster is a good example of that, right? And sometimes political events and wars are examples of these things because there often maybe no way to anticipate it in advance. And of course, we can also apply this same logic to investing. All right, so let's go ahead now and discuss that. Fourth quadrant. We do not know what we do not know. In the investing business, it is impossible to be right all the time. And we typically know this from experience, right? Whenever we make investments, we are never really able to achieve a 100% success rate, right? And that's assuming you make, more than one or two investments. And the reason for this is that because there are these events in the fourth quadrant, which can impact our investment and which we really have no way of anticipating ahead of time. So this often sometimes creates the illusion of genius or illusion of being very, very strong if there's a successful bout in the stock market, right? So if you make a couple of investments and they do very well, this may give you an illusion that you're an extremely smart investor and that, whatever you invest is going to do very well. But that's, not usually the case, right? Because typically, there's a lot of randomness in the stock market, right? And, but just by chance, you can be right a few times in a row. So it's important to keep in mind that, just because you have a couple of winners, that doesn't mean that all your future ones are going to be winners as well, okay? So it's important to understand the limitations of one's knowledge and just appreciate the fact that there is a lot of randomness in the market. We cannot eliminate risk. So however thorough our analysis may be, we're definitely not going to be right all the time, right? There's still always going to be some risk involved. Great investors tend to recognize the limits of their knowledge and understand that humility is the best way to survive unexpected outcomes. So once you reach a certain point and you have enough experience in the markets, you'll appreciate the fact that, you cannot be right all the time. And there's limits to your knowledge and limits to what you can anticipate that's going to impact your investment. And being humble and just appreciating it and taking it into account is the best way to survive these unexpected outcomes. Obviously, good risk management techniques are also very important. And we can certainly, help ourselves by by recognizing the things that we don't know and recognizing that there are things we don't know that we don't know. And here's a good quote by George Soros to nicely sum up this idea. Once we realize that imperfect understanding is the human condition, there is no shame in being wrong, only in failing to correct our mistakes. So what this is telling us is that we should work on correcting our mistakes. And there's nothing wrong with making mistakes to begin with, right? It's normal to make mistakes. It is going to happen, especially if you're going to invest regularly. Conclusion. So this now brings us to the conclusion of our lecture on behavioral finance. In this lecture, we've studied how the presence of thinking participants in social science gives rise to a different set of conditions that are not generally seen in natural science. We talked about how market participants base their buying and selling decisions not on objective conditions, but on their limited and imperfect interpretation of those conditions. Right, so I think the key message from this lecture, and just the idea of behavioral finance in general, is that, investors do make mistakes, and that's common to every single investor. Every single investor is going to make mistakes. And really, the best thing to do is to learn from them and try not to make them again. Right? The more we learn from our mistakes, the less future mistakes we'll make. And the value investing approach is really designed to take advantage of the fact that investors do make mistakes, right? Because Mr. Markets often has irrational and emotional driven behavior, value investing, gives us the opportunity to find stocks that are undervalued, right? And it's only because of these behavioral biases that we get undervalued stocks in the first place. And we also talked then about the 4 quadrants of awareness, and a good understanding of these 4 quadrants can really help an investor in developing self-awareness, right? By understanding, your knowledge and the limitations of your knowledge, right? Which is essentially what these 4 quadrants are all about. That will help you become a more successful investor. And this is really a key ingredient to achieving success in stock investing. And it is something that we see in a lot of, very famous investors. So behavioral finance is, extremely important, because, our behavior, is ultimately going to be a key factor in determining whether we are successful as investors or not. So, as we said, now we've reached the end of behavioral finance. In the next module and the next lecture, we'll talk about portfolio analysis. And here we're going to spend a bit of time talking about portfolio allocation. So, how to pick different stocks, diversification, right? So how to insure yourself against, risks of individual stocks doing poorly, and also when to sell a stock, right? So obviously we've spent, most of this course talking about how to decide when to buy a stock, right? By analyzing the company and understanding what it's worth. And then we'll also want to spend some time knowing, well, once you've made your investment, how long should you stay in it and when should you sell? Okay, so this concludes our lecture. Thank you very much for listening, and we'll see you next time.